When you have a pension for retirement, you're typically given two options on how to spend the money. You can either do a lump sum rollover and move it into an IRA and invest it yourself, or you can take it as a lifetime income for the security and higher income. And this is the same situation that a Chinese immigrant retiree found herself in, and her children reached out to me for help. I felt this was a pretty straightforward case study, so I wanted to go over the situation she was in, how I analyzed the numbers, and the recommendation I gave, and finally the path she chose to take. Now, before we get started, my name is Jason Ko. Welcome. I have been a financial advisor and certified financial planner for over a decade, but I am not your financial advisor, so this video is for educational purposes only. So the situation the mom was in is that she was in her mid-60s and will be retiring in a month. She has saved up $90,000 in her 401k, which she and her children feel is not a lot. She has begun taking Social Security and also have a pension from work. The pension has given her the option to either take out a lump sum of $304,000 or as a single life annuity with a monthly income of $2,275. Her lifestyle needs are modest, so if she were to take the single life annuity along with the Social Security, she would be able to meet her income needs today. But the downside is that the single life annuity is fixed and doesn't grow along with inflation. So my goal was to share an objective analysis of the expected return from taking the single life annuity and compare it to investing in a broad index fund portfolio of stocks and bonds and see which one would turn out the best for her. That way they can make an informed decision on whether to take the lump sum and invest it in stocks and bonds or to take the single life annuity. So when they initially came to me, they said that they were actually leaning towards taking the lump sum, because there isn't too much savings outside of retirement accounts. Also, the mom wanted to leave some legacy assets to give to her children. So I reviewed her pension statement and provided her with the following analysis. So I wanted to help her solve whether to take the lump sum or the lifetime annuity. And it's important to do that because, again, she had an initial desire of leaving assets for her children. Because they didn't have too much savings in the bank and in a 401k, she wanted to have a higher level of reserves for emergencies. I had a couple of questions before I was able to finalize my recommendation. The first one was, does the pension come with a cost of living adjustment called COLA? Unless you're working for the government and have a pension from them, most pensions are fixed and does not have a cost of living adjustment. And the second question I had was whether she was allowed to take a bit of the money as a lump sum and a bit of the money as a single life annuity. If she were allowed to do that, then she can craft the perfect income plan for her while meeting the reserve needs that she wanted to have. What I found from our follow-up conversation was that there was no cost of living adjustment on the pension, and also the choices of how to take the money was an all or nothing decision. She either had to take all of it as a single life annuity and all of it as a lump sum. So let's go over some of the numbers again. The lump sum amount was $304,000, or she could take it as a lifetime income of $2,275. Along with a single life annuity, there are two other options: the 5-year period certain and the 10-year period certain. And what these do is to address the risk that people will take the single life annuity and then somehow get hit by the bus and pass away very soon afterwards. When you sign up for the 5-year period certain or 10-year period certain, then the beneficiaries of your annuity will at least get it for 5 years or 10 years. But because it does have a higher level of guarantee, they do have to take some of the money off the table. And because the mother was widowed, she's not worried about providing a stream of income for her husband. And because her children are decently well off, we didn't really need to consider the 5-year or 10-year period certain options. So I did a straightforward analysis to analyze if she were to take the income annuity today and she were to live to age 75, age 80, 85, 90, 95, 100, what are the rate of returns? So if she only lives until age 75, she actually loses money. She doesn't even get the $304,000 back in return. Now, if she lives to age 80, then she would be earning a 2.3% rate of return, which is not attractive at all, even if it's guaranteed. If she lives to age 85, then she will have earned a rate of return of 5.6%, which is comparable to a high yields interest rate account today. But if she lives to age 90, then I do think it is starting to pay off because she would be earning a 7.1% rate of return with no market fluctuations. And if she lives to age 95 or 100, then it's gravy on top. But you can see that the rate of return are never double digits, not super attractive. But once she lives to age 90 or above, then it does become a pretty good source of income. And for those who are interested in doing this analysis yourself, let's go ahead and jump to the Excel spreadsheet that I use to come up with a calculation. So what you would do is put in the cash flow in annualized terms. The first one is you would put the amount that you are giving up as a lump sum, $304,000, as a negative value. Then you would get your annualized income as a positive value. And all you do is use the internal rate of return function, IRR, and highlight all of the cash flow. You can see it highlights the first negative $304,000, And then if you want to calculate the rate of return until age 90, then you highlight until age 90. So it's fairly easy to go and do the calculations for various life expectancies. And you can see I have the same values here. So let's use this. You can see it highlights only from age 67 to 75. And for age 100, then all you do again is type in IRR, and then you highlight the cash flow up to age 100, and you get the same rate of return. So let's jump back to the rest of the presentation. My overall summary and recommendation for them was that she would have to live until age 85 for the rate of return for her to receive to be comparable or slightly better than having the money in a high yield checking account. She would have to live until age 90 to earn a 7% rate of return, which I think is an acceptable rate of return compared to a portfolio of stocks and bonds, which historically speaking, depending on the risk profile, earn anywhere between 6 to 10%. And given that the mother's parents' age when they passed away is in their late 80s, I felt that the income annuity might not be the best choice. So the main benefit for her to take it as a single life annuity is that there would be a higher rate of income today when compared to withdrawing from a traditional 60-40 portfolio. And the income is also guaranteed and free from market fluctuations. So let's compare it to having your portfolio invested and have a safe withdrawal rate that you implement. This number is assuming a few things. The $304,000 along with the $90,000 that she has in a 401k is invested in a 60-40 portfolio that is diversified across the globe. And 60-40 again is just 60% in global stocks and 40% in global bonds. Given her age of 67, we could assume a safe withdrawal rate of about $1,527 before taxes. And if the market grows by 5%, then there would be room for a pay raise, an increase of $81 up to $1,608. Now, if the market goes down by 35%, that's when she would need to consider making a reduction in her lifestyle spending by $76 down to $1,451. And at this point, I made a joke with her that all she needed to do was to go out to eat dim sum 2 less times per month, that she would be able to weather the storm. And you can see a difference here. With a 5% growth, you can give yourself a pay raise, and you can tolerate up to a negative 35% drop before you would need to consider reducing your income. And this is because with a diversified portfolio, you do have a very high likelihood of seeing your account grow every decade or so. Even if there is a short-term fluctuation, you can still continue to spend money in retirement without completely cutting it off, which many people tend to do if they don't have a higher degree of confidence in their retirement income plan. So this shows the historical backtests of the various incomes at different success rates. In the median, which is what I look at, you can see over the first 10 years, she is able to grow her income over time from the $1,500 number up to $4,000. It stays flat for a little bit, and then there is a big reduction during the 2022 year in which there was a significant drawdown in stocks and bonds, and diversification didn't really provide much benefit. And at that point, she had to reduce it by just a little bit over $2,000. So that can be a big jump down. And in some really good cases, the income continues to grow to $12,000. In some really bad cases, the income never really grows and it just stays about $1,500. But this would take years of sustained bear market, but it is an event that happened. A table format of the median outcome, the income starts at $1,500 and then it grows to $4,000 with an average of $2,400. The worst case scenario, the income starts at $1,500, but then it does go down to $851, with the highest is $1,790. And this chart is the legacy asset that is left over. So she starts out with just a little bit under $400,000. So what you see here is an overall trend of a downward reduction of her asset levels. And the median outcome leaves the children with $214,000, which can still be pretty attractive. The worst case scenario was the children being left with $85,000, the best case scenario being left with $1 million and over. But many people's fear is that they don't want to run out of money in retirement. So seeing this, knowing that they can spend a little bit of money, make moderate adjustments over time, and still have some assets left over for their children, that's a very balanced outcome that many people would find attractive. So the overall benefit of doing a rollover and taking the money and having it invested is that you have control over the investments. And for some people, that's very important. You can also control the spending as well. And there is a potential for growing income stream and legacy assets to pass down. If she did a rollover and have the money invested and she started the retirement income plan and she passes away early, then all of the assets can be passed down to her children. And finally, because she is in a relatively low tax bracket, she can execute a Roth conversion ladder where she converts a bit of her IRA every year in order for her children to inherit more tax-free assets when she does pass away. Given that she did not have the option to take a bit of lump sum and a bit of the single life annuity, and because she had a desire to leave some legacy assets and also have a higher level of financial reserves today, I made a recommendation to do the lump sum rollover. Despite their initial desire to take the pension as a rollover, after talking to me, the mother decided to take the pension as a lifetime annuity. Doing so will allow her income to be higher than what an IRA can support, and she would not need to take on investment risk in the stock market. She will be limiting her future income because the lifetime annuity is fixed and won't grow with inflation. And currently, the expected 10-year inflation rate is 2.3%, so that will mean a decade from now, a dollar will only be worth 80 cents, and her single life annuity of $2,275 will only be worth $1,820 in today's dollars, so she will have to make a reduction in her lifestyle spending. And to make sure she doesn't actually lose money from taking the lifetime annuity, she has to make sure to take care of her health, which is always a good idea, so she will live past 80 years old to reach that break-even point where she's earning a decent amount of return. And finally, because of the short-term trade-off that she has made, she will have to make sure to invest the $90,000 in her 401k more towards growth to fight future cost increases, especially with regards to long-term care expenses, which are growing at a much higher rate than base inflation. Although I didn't gain a new client, I was glad to be able to help them make a more informed financial decision. I'll be making more videos to help millennial Asian Americans better plan for their parents' retirement, so if you want to help me, please like and subscribe. And I hope you stick around, and thanks for watching.